Hello students, welcome to ShirtBack Academy. In our lesson today, we're going to be continuing in our personal finance course. We're going to be in Module 1, Money Management. This lesson will cover Section 1.3, Cash Flow. Let's begin. What is cash flow? Cash flow is the increase or decrease in the amount of money that a business or person earns or spends over a period of time. We can measure cash flow on a weekly, monthly, or yearly basis. It's important to understand the different types of activities that are defined within cash flow. There are three common to be familiar with: operating, investing, and financing. Operating activities are cash that are generated from the purchase of or sale of goods or services. The purchase of goods are called expenses. The sale of goods are called revenue. Investing activities are transactions that are related to what are called non-current assets. These are assets or things that we own that we hold over the long term. These would be things such as office buildings, pensions, investments, and equipment. Financing activities are cash that we have that are related to liabilities or any other equity we have in an asset or business. Liabilities are cash that we owe to other people. These typically can take the form of what are called installment loans. These are loans that we pay on a monthly basis. Equity is something that we own in an asset or business. We can get cash in the form of dividends or stock sales. Cash inflows are the money received by a person or business from any source over a defined time. Occupational income is the money we earn from working at a place of business or through self-employment. Revenues are the total money amount of sold goods or services by an individual or business. Dividends are the monetary amounts that are paid to shareholders of stock in a business. Dividends represent a distribution of a company's profits to its shareholders. Finally, we have inheritances. Inheritance occurs when money or assets are given by a deceased person, a dead person, to family, friends, or organizations. Over in the screenshot to the right, we have some other examples of cash inflows. Cash outflows are the total cash and money spent by individuals and businesses over a defined time. We measure cash flows on a weekly, monthly, and annual basis. Salary is the amount of money that's paid to an employee over an annual rate. Salaries are measured over a yearly basis. For example, a teacher may make $75,000 a year. They would make a monthly or bi-weekly proportional amount of that salary. Wages are the amount of money that's paid for total hours worked by an employee. For example, a laborer may earn $25 for every hour worked. Expenses are the money amount that is spent to purchase goods or equipment by a person or business. Another cash outflow is interest. Interest is the cash that we pay to lenders in addition to the amount that we borrow on a loan. The amount that we borrow is called the principal. The interest is the extra money we pay for the servicing of the loan. In the screenshot to the right, we have some other examples of cash outflows. Net cash flow is the difference between the total money inflows and outflows. It's the remaining cash we have after all debts and expenses have been paid. A positive cash flow occurs when the total cash inflows are greater than the outflows. Negative cash flow is when the total cash outflows are larger than inflows. If we have a positive cash flow, a good best practice is reinvesting. This is the process of spending our excess cash to improve our business or our work skills. These could be things such as purchasing new buildings or doing employee training. Cash flow statements are the documents that provide records for all of our inflows and outflows over a period of time. They help us to show whether our cash flow is positive or negative. In the screenshot to the right, you see a sample cash flow statement. Here on the top, we have our cash in. We have several different types listed. On the bottom, we have cash out. We use our cash flow statements to determine which amount is larger. We compare our in and outflows and we get an ending balance. Our statements should define all the money and earned that is spent on the three core cash flow activities. Remember, we have different activities for operating, investing, and financing. Each of them should be accounted for separately. Current assets are all the cash, buildings, and equipment that are owned by an individual or business. The current liabilities are all the amounts owed to creditors. When we create our cash flow statements, we also must account for impulse buys. Impulse buys are unplanned or unnecessary purchases and expenses that arise during a cash flow period. We should always document our impulse buys depending on the time period we use them. We can measure our impulse buys on a daily, weekly, monthly, or annual basis. Daily impulse buys may be your Starbucks coffee. A weekly impulse buy may be going to a movie. Monthly impulse buys may be buying some new clothes. And an annual impulse buy might be a vacation. Even though impulse buys are unplanned, we still must include them in our cash flow measurement because they do use up and spend our money resources. That will conclude this lesson. In our next lesson, we will cover section 1.4, Financial Planning. If you have any questions about the contents of this lesson, please review the course notes for section 1.3. We thank you for following along to the video, and we'll see you in the next one. Enjoy the rest of your day, everybody.